Welcome back to Morning Trade Live. Joining us, Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab, to take a look around the world where there are also indexes making all-time highs. Jeff, this is not a U.S. exclusive event.
Yeah, that's right. We've seen Europe's stock 600 index climb back above its prior high. That was 2 years ago, back in January of 2022. A few things going right in Europe. Economies may be getting back on track. And we've also got Japan's Nikkei 225 hitting a new all-time high set 34 years ago. We've talked about it on this show. Long time coming.
That has been a long time coming, and also a long time crucial component of like the bear case for demographics, debt, and post-bubble problems. Like, for those that are looking for long-term bear cases anywhere, they've been able to point to Japan for a long time, saying if you do this, if you do that, for whatever reasons, that you're going to get stuck. And maybe stocks don't always go up. So have we learned that they do now?
Well, Japan does have its handful of unique problems. Its demographics are not good. Its debt to GDP ratio is the worst in the world among developed economies. But we've got to remember that the economy and the companies are two different things. Japanese companies like Sony and Toyota get 70 to 80% of its sales outside of Japan, according to their earnings report. So they're much more tied to the global consumer, even the US consumer, than domestic Japanese ones. And that exposure has helped to propel earnings growth, even as domestic economic growth fell into a recession last year. Corporate profits for Japanese companies were up 8% last year, despite Japan slipping into a recession. So don't get too caught up in Japan's bleak economic outlook, focusing on its companies, which are absolutely global. We're talking about Sony, Toyota. These are the companies that you want to focus on, that are really driving the markets here. And you can see their valuations aren't anywhere near stretched here. In fact, despite this 30% rally over the last 4 months to new all-time highs, stocks in Japan are in line with their 20-year average price to earnings ratio. That's a lot better than here in the US, where they're 32% above their longer-term PE.
Okay. So is there a connection, though, macro-wise, outside the companies, to what the central bank is doing now? Is there some truth in the notion that maybe zero rates were holding back this economy, that maybe there is a projection to our own economy a little bit, because we're kind of all scratching our heads going, how are we so strong after hiking rates as hard as we did? And one of the things I've argued is that maybe rates too low actually hold economies back.
I think there's some truth to that. Certainly, negative interest rates in Japan are a burden, are a tax on businesses and consumers, excuse me, who aren't seeing any kind of return on their capital. Japan's been in a deflationary environment for a very long time. That appears to have changed. Negative rates are no longer appropriate in Japan. The prospect for rate hikes is merely a reflection of the fact that maybe investors, consumers, for example, in Japan. I know I mentioned they're not a big part of what drives the stocks, but it's worth noting that deflation causes people to delay buying things, right? You just expect prices to fall in the future. Now that they're expecting inflation going forward, that's brought consumption forward a little bit. So that's energized their economy to some degree. Still in a recession, but emerging from that, things are looking a little bit better with rates moving higher. I'd also note the capital is flowing back to Japan in the last 3 months. We've seen foreign investors moving money back into Japan on the idea that maybe the yen might be a little bit stronger. And so not only do you get the world's best stock market this year, but you get that potentially along with a rising yen later this year as the Bank of Japan begins to hike rates as other central banks are cutting them. That's another attractive reason why capital is moving back to Japan.
Okay. What do you think the message is for investors in terms of shifting their portfolios to accommodate for this stronger market? Should we just tweak our international holdings? Should Japan's tech be part of our tech in terms of figuring out how much we want to allocate to that sector? How does it fit into our strategy?
Yeah, I think all of the above. It's not too late is the most important thing. Japan's stock market, I think is going to continue to surprise investors as it sets new all-time highs. Further gains by what is the second largest stock market in the world can help to boost the performance of a broad allocation to non-US developed market stocks. Stocks headquartered in Japan are the biggest weighting in the EFI index. The MSCI EFI index is, of course, the basis for many international ETFs and mutual funds. It's the largest share of any country in the index, and it's not too late for investors to consider rebalancing their portfolios from the US to non-US developed market stocks after decades of US outperformance. This chart right here is an interesting one. It just shows within Japan, the allocation to stocks is very low, to cash it's very high, and that's the opposite in the US. What we're seeing is that new accounts, and this accounts, Nippon investment savings accounts in Japan, which just began this year, are starting to shift that a little bit, designed to get investors out of cash, which is yielding nothing, into the stock market, which is, again, the best performing one in the world this year. So another reason why even domestic investors in Japan are reconsidering Japanese equities.
That's a pretty fascinating chart. So this has all been happening without a lot of self-love from the Japanese for their equity market.
Yeah, very true. And you know, Warren Buffett's been on the cusp of this, right? Started allocating more to Japan a few years ago. So we're starting to see investors around the world moving money back to Japan after they used to borrow in Japan because it was a cheap place to borrow money and then invest elsewhere around the world. That's starting to reverse now with capital flows moving back into Japan and domestic investors in Japan returning money back home as well.
Okay. All right. So there's still some room here, it seems, to shift allocations over, especially when it comes to international investors to stocks in general. You would think that they would take a swing at their home indexes and home markets. So we'll see if that chart changes throughout this year. Certainly seems to suggest there could be some more room for valuations to grow. To come back to that valuation chart we flashed up earlier, I just wanted to pull that up again because there's a U.S. statement in here as well with the S&P PEs getting back close to where we were during COVID. Not quite there, but Japan, just a totally different story. It's like they haven't even moved to the other side of the other half of their range.
Yeah, that's right. There is still a lot of pessimism baked into Asian valuations. Remember, China's economy is still lumbering through a very difficult property problem. So generally throughout Asia, where a lot of investors who invest in the Japanese markets are based, there's still a bit of pessimism over there. That could be starting to turn around. But yeah, we've got a long way to go. Valuations were near their 20-year lows just a year or so ago. So we're really just coming off of very depressed levels.
Okay. Jeff, real quick, last chart, your cardboard box recession you've been tracking, one of the indicators of the global economy, has, it looks like, almost fully recovered back to kind of neutral. Does that mean we should be looking for global manufacturing figures to also firm up?
Yeah, this is key because last year it was the manufacturing part of the world that was the weakest, including Japan slipping into recession. Japan's a big manufacturing-based economy. So as this is turning around, and yes, that's the PMI on there, that's the orange line, that's Purchasing Managers Index, a survey of manufacturers, which showed a very mild but lengthy downturn over the course of the last year. And of course, the blue line is demand for cardboard boxes, the thing those manufactured goods go into. That's rebounding as well. So both these indicators pointing to better growth in manufacturing in 2024. So that's a reversal of the sector leadership we saw much of last year, whereas more service-oriented businesses did very well. This year, we could see a return to manufacturing leadership, industrials, energy, materials, and we've got a number of those businesses in Japan as well. It's one of the reasons why Japan's stock market's up 17% already this year.
Okay. All right, Jeff, thanks for the look here. Good setup for the rest of the world's stock markets led by Japan. It seems to firm up. Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab.